Good morning, everybody. Thank you for joining our session this morning on the interplay between transfer pricing, customs, and value-added tax. We're just going to take just a 30 seconds to a minute, just as a few people are still joining, just to allow them join, and then we'll move into the session. Okay, we actually have quite a few people who have logged in already, so we may get started in the interest of time. Thank you very much for joining us this morning to discuss this topic around transfer pricing, customs, and value-added tax. As we get more taxes in the region and regulations, the interplay between these taxes will become very important. And that's why we're going to try and talk today a bit about why this may be relevant for your business and other businesses. So maybe just start with some brief housekeeping rules. This session will be recorded. We will share it with you afterwards, or if you request it for anyone else, we can also share it. We have some questions. We've had quite a few questions come in advance of the session. We will try and address some of them towards the back end. If not, if the content itself doesn't cover it, but certainly we can also take questions directly after the webinar. We'd also greatly appreciate your feedback after the webinar is complete so that we can obviously augment or improve for future webinars to ensure we meet your needs. Okay, so we'll start by introducing some of the panelists that we have. So by way of introduction, my name is Keith Donegan. I lead the indirect tax practice here in the UAE, and I have been leading the practice and been involved in KPMG for the past 6 years. I have a broad experience of indirect tax from the region, Australia, and Europe. I'm also joined by a very experienced colleague, Julie Lerpland, who's a director in the team with over 20 years experience, both from the region and also from Europe. We've also got on the panel this morning, Ramya Iyer, who's a SME in transfer pricing, and she will cover more of the transfer pricing aspects, and again, has vast experience both locally and from the subcontinent with over 15 years experience. And last but not least is my colleague, Edson Trevino, who is a customs and international trade expert with a lot of experience locally from Europe and from South America. So good experience in the panel to bring you a flavor of experiences from elsewhere, as well as local developments. So the topics that we're going to cover today in today's session are, firstly, I will set out why this is relevant for UAE businesses. We'll then look at, in a much deeper dive, the actual convergence between TP, customs, and VAT. We'll then step one step further into some practical examples of how this applies and where it might apply to your businesses. And we'll have some key takeaways towards the back end, along with some Q&A. So we'll move into the first topic. So that is why is this relevant for UAE businesses? So there's a number of reasons why this will be relevant for UAE businesses. So essentially, as we move away from an environment where there's either been no tax or some customs and some VAT, we're now moving into an environment with a lot more taxes, rules, and regulations. None of these operate in a vacuum. TP changes, adjustments, TP policies have a direct impact on customs as well as VAT. So it's important that there's the correct information flow between the various parts of the business responsible for each of these tax heads and rules and regulations. In many cases, customs may sit within your logistics part of the business. Other parts of the business, such as finance or even a new tax function, will have coverage for TP and VAT, and even the commercial teams will have input on pricing. So All of these things are, all of these parts of the business need to have accurate and correct information flow so that we don't end up with disjointed positions across transfer pricing, customs, and VAT. Now, it's also important that we find the right balance between the different business units and geographies as well as authorities. Obviously, we've got domestic transfer pricing, but there's also the international transfer pricing which is coming in, and of more relevance to businesses with a global and regional footprint. So the positions being adopted for regions are important. The tax authorities themselves are going to be sharing a lot more information, as are the customs authorities going to be sharing a lot more information. And it's very, very important that we're aligned in the positions that we adopt, because if we don't, that information share will quickly show up the fact that potentially we're underpaying or overpaying customs or VAT in a given jurisdiction, or the transfer policy that we said that we have isn't actually what's coming out in practice, because we can see through the customs authority prices or the VAT returns that that's not what's happening in practice from a unit sale perspective. Now, it's important that we also have this information share across each of those tax heads and transfer pricing in order that we can build up, I guess, a mitigation or action plan, which essentially would be an ability to have a defense file in place if challenged by any given tax authority or customs authority in a given jurisdiction, so that you can evidence and support the positions which you have adopted. And that's where we kind of talk a little bit about, well, how best to address some of the new challenges that we're going to face. And I think the key one is making sure that we do not operate in silos, that the information is available across the different business heads, that when we're making decisions in transfer pricing, we have cognizance of the impact on customs and VAT, and that we have the correct documentation that sits behind both customs and VAT to support the transfer pricing policy and vice versa. So we need to be proactive around this, making sure that as we introduce these policies, that we also are aligned with the different parts and communicating frequently with the other parts of the business. A good way to do this would be to have standard operating procedures as well as internal policies for potentially parts of the logistics or procurement teams, as well as the finance and tax teams, so that you know the triggers when each party has to be involved, and you also know how to access and exchange the relevant information. These, obviously, there's a much deeper level of analysis and policies to be put in place, but these are some key high-level things to think about in terms of the interplay and making sure that you don't have any nasty surprises if audited down the track. So that's a little bit just on the overview of why this is important. Now I'm going to hand you on to my colleagues to go through the convergence of transfer pricing, VAT and customs in a bit more detail, as well as then moving on into some of the more meaty topics that we've got for you today. So over to you guys to walk through this convergence of the various tax heads and TP. Thank you.
Thank you, Keith. So good morning, everyone. To understand the relationship between transfer pricing, customs, and value-added taxes, one must first understand the drivers for them individually. For transfer pricing, the tax authority expects taxpayers to ensure that the price charged for related party transactions comply with the arm's length principle. For instance, for a purchase transaction, the price must be set out as if the parties were not related and had been negotiated under normal business conditions. Moreover, the transfer price must not include elements that overstate value. On the other hand, it would be desirable for the taxpayer to have a higher price for the purchase transaction, thereby reducing the overall profit that is offered to tax. In many ways, transfer pricing and custom valuation are inverse of one another, as would now be explained by Edson.
Thanks, Ramya. Well, from a customs perspective, there is a main principle to take into consideration, that is that any tangible good that is crossing borders should have a value, right? So mostly in in worldwide, the value that is being used is the transaction value, right? It accounts nearly 90 to 95% of total global operations. And it is essentially the paid price or payable price for the goods being imported, right? So here it is relevant when the seller, exporter, and the buyer, the importer, are related, right? Because in this case, the customs authority will assume that such relationship may affect the price or the value declared at customs. So then the challenge here is that the customs authority may ask and have the main objective that when the goods are bought from a related seller, the importer should justify that that relationship didn't affect the price, right? So that's the main objective of the customs authority, and obviously the customs authority assumes that the importer may tend to declare a lower value in order to pay lower customs duties, right? So that's the main assumption. Nonetheless, there are some means to justify that such relationship didn't affect the value of the goods being imported. So I will pass over to my colleague Julie to get some insights from the VAT perspective.
Yes, thank you, Edson. So for VAT, actually, specifically in UAE, the I would say worldwide principle is being applied that for VAT purposes, for determination of import VAT payable, we actually look at the customs value. So that basically determines what will the value on which the VAT will be paid. And it's customs value plus the customs duty paid. So in that sense, VAT doesn't have its own rules of determination, but more or less follows the customs valuation, which makes it slightly easier from VAT perspective, but makes VAT very reliant on customs in this case. So, and as both Ramia and Edson mentioned, why is this topic very relevant? Because in both cases, for TP and for customs, the authorities assume that the price between related parties is not necessarily fair and comparable to the market price. So with that, I let my colleagues explain what is it that is considered from both tax points, the related parties, and what are the concepts that need to be applied to the value.
Thanks, Julie. So two concepts which are required to be understood in this particular section would be the definition of related parties and the arm's length value or customs value under the transfer pricing regulations or customs regulations. Related parties. So related parties may exercise influence over a taxpayer's financial and operational decision-making, including pricing decisions, which is why it's important to consider this. The UAE transfer pricing rules apply to related parties, which are essentially defined to include pre-existing relationships between the taxpayer and another entity through, say, kinship, that is in case of natural persons, ownership, which could be through direct or indirect ownership interest of 50% or more, or control, where one may exercise significant influence over another under several circumstances which have been elaborated in the UAE transfer pricing guide. The law also provides that a permanent establishment of a taxpayer is to be treated as a separate and independent entity from the head office itself, and all arrangements between the head office and this permanent establishment are required to be at arm's length. We've spoken about the concept of arm's length many times already. And just to summarize what arm's length principle and arm's length value means is that this arm's length principle requires that the prices charged for goods, services, funding, use of, say, intellectual property, or any other transaction or arrangements between these related parties is required to be comparable to what would be charged in similar transactions between unrelated parties. Edson would now take you through the definition of related parties and transaction value as defined under customs.
Thanks, Ramya. Well, from a customs perspective, it is important to mention that the customs valuation principles applied by most of the countries around the globe, including the UAE, are based on the agreement in the implementation of Article 7 of the General Agreement on Tariff and Trade, dated in 1994, GATT, that nowadays is WTO, right? And this is commonly known as the WTO Customs Valuation Agreement. So, as per said agreement, it provides a definition of related parties that is wider, as we can see in the slide, and also it has some similarities with the definition provided by the corporate tax law in the UAE. For example, partners legally recognized, the common control rule, the ownership rule, the officers and directors of each other a company, and the more evident relationship that is family members, right? Nonetheless, here it's important to highlight the main differences. For example, the one related with the ownership rule, that from a customs perspective, it provides that there is a relationship when one party holds 5% of the voting stocks or voting shares of the other company in comparison with the 50% that is provided by the corporate tax law. And also, we have, for example, permanent establishment that is mentioned in the corporate tax law, but nonetheless, that definition is not included in the customs valuation agreement. However, it can be considered as within a direct control clause, right? So now, evaluating whether an exporter, seller, importer, buyer are related is important when we talk about the transaction value, because as I mentioned previously, the customs authority will presume that such a relationship has affected the value of the goods, right? So if we take a look at about what transaction value is according with the WCO Customs Valuation Agreement, we have that this is essentially the price actually paid or payable, right, for the goods when sold for export to the country of importation, okay? And that transaction value or that paid price or payable price should be supplemented for some adjustments as per the same regulation. So which are those adjustments? Let's walk through them. All right, so we have two types of adjustments to the transaction value, additions and deductions. So additions here, it is to know that they will happen only if they are not included already in the price, right? So it is not like if they are already included in the price, you should add twice. No, that is not the case. So those additions should be added as long as they are not included in the price. So some examples here as per the WTO Customs Valuation Agreement, we have, for example, royalties. So the first one is royalties that are essentially payments, right, that the buyer should pay to the seller to the in relation to the goods being imported as a condition of sale. Okay, that is a quite important requirement to fulfill, that there should be a condition of sale, and also that such royalty should be related with the imported goods. We also have that we call assist, right? That are essentially goods supplemented by or supplied by the buyer to the seller for the manufacture of the goods being imported at reduced prices or free of charge. So those concepts should be added as well to the transaction value. And then we have proceeds that are essentially some amounts that are accrued back to the seller as a result of any subsequent use, right, or sale of the goods being imported. Okay, and then we have what we call CIF for just easy reference. That refers to all the insurance and freight charges applicable to the importation of goods up to the point where they are imported, let's say at the first point of entry, right? So here is quite important to take into consideration the Incoterms. For example, if the buyer and seller are dealing or agreed an Incoterm that already includes those concepts, insurance and freight internationally, those charges should not be added twice, right? And then we have the deductions. So in terms of the deductions, possibly the main point here is highlighting that such charges should be clearly identified and distinguished from the paid price in order to be able to deduct them, right? Some examples we have here, technical assistance that is provided from the seller to the buyer after the importation of goods. We have some other charges related with transportation, handling, packaging, and connected activities rendered after the importation of goods. So if those charges are embedded into the price, should be deducted or can be deducted. And then we have dividends and other payments that do not relate to the imported goods. That is a quite important condition. And some other aspects such as financing costs and buying commissions. Okay, so now we will take you through the main difference between the TP methods and the customs valuation methods. Over to you, Ramya.
Thanks, Edson. So transfer pricing methods. What are transfer pricing methods? So transfer pricing methods are used to establish whether the related party transactions are conducted at arm's length. There are 5 internationally accepted transfer pricing methods, which are detailed in the OECD transfer pricing guidelines and now have been included in the UAE corporate tax law as well. These methods are the CUP method, which is comparable uncontrolled price method, resale price method, often called as RPM, cost plus method, which is CPM, transactional net margin method, which is TNMM, and transactional profit split method, which is PSM. If none of these 5 recognized methods can be reasonably or reliably applied, the taxpayer may adopt an alternative TP method to satisfy the arm's length principle. I will now try to explain the application of these methods in the context of purchase transactions for the purpose of trading purposes. So under CUP method, a taxpayer would be comparing the price of the product between related parties and unrelated party transactions in comparable circumstances. What is critical to apply the CUP method is a very high degree of comparability that must exist in order to be able to compare the prices. So, for example, let's look at an organization, an entity, which has standard rate cards across all products, which they offer to related parties and unrelated parties. And as such, this CUP information is readily available with them. Moving on, let's try to evaluate the resale price method. Now, resale price method is generally applied when final transaction is with an ultimate distributor. So the resale price, that is the price at which this particular taxpayer is actually selling to the third party, is reduced by the gross margin determined by comparing the gross margin in uncontrolled transactions. So how does it compare to the cup method? Cup method is related to prices. This one is related to gross margins. The other method that you could potentially apply in purchase transactions is the transactional net margin method, which is a commonly used method and examines the net profitability of the related party and unrelated party transactions. There are two other methods, as you can see, the cost plus method. Now, cost plus method may not be suitable in a transfer pricing context because this relates to the cost plus markup, which one applies to the production costs of these services or costs. This method is typically applied in, say, assembly operations and not trading operations. There's also the profit split method, which is appropriate to establish the division of profits which may be earned in independent situations. Typically, this is applied when the related parties engage in highly integrated business operations for which a one-sided methodology would not make sense. I hope this is clear, and now Edson would take you through the methods for customs valuation.
Thanks, Ramya. Well, from a customs perspective, we have six customs valuation methods, right? So the main thing, first of all, to highlight here is that there is a subsequential principle here, which means that the importer should apply them subsequently, all right? So that means that the first method, or method number one, is the transaction value, okay? Which, as I mentioned, is based on the payable price or paid price, right? On the goods being imported. And then along the way, if the transaction value is not applicable, the importer should evaluate the subsequent alternative customs valuation methods and substantiate and document whether one method is applicable or not. Okay, so if we take a close look into the transaction value method, so here it is important to mention that there are two main conditions, I will say, that I would like to highlight here for using the transaction value, among others. The first one is that the transaction value should result as a sold for export to the country of importation, which means that the goods should be related with that sale transaction, okay? Because we may have imports that are not related with a sale transaction, for example, for leasing purposes, renting purposes, or under consignment, that the sale is made afterwards. And in that specific case, at the moment of presenting goods at the border, at customs, there is no sale transaction. So in principle, if there is no sale, the transaction value cannot be used, okay? And then the second condition is that, as I mentioned previously, that the seller and buyer, if they are related, that relationship should not affect the value of the goods being imported, right? So here, transaction value, as I mentioned at the beginning, is the most used method. And it has a lot of kind of implications and analysis around the transfer pricing, because the nature of the good the nature of the method itself, that is related parties, not affecting the values. And then if the customs authority has any question or doubts that such relationship did affect the values or the prices of the goods being imported, the customs authority will implement some resources to analyze, first of all, the circumstances surrounding the sale, and secondly, test values. So, but the main is the circumstances surrounding the sale in order to ensure that the goods have been valued according with the common and applicable pricing setup practices in the industry, and that the price has been set as whether the buyer wouldn't be a related party, right? Actually, here it is important to mention that um, as per the commentary 23.1 of the Technical Committee on Customs Evaluation of the WCO, it is mentioned that the transfer pricing documentation can be used to analyze the circumstances surrounding the sale, right? But this is just on case by case basis. So that is one point that it's important to bear in mind. And then if we go run quickly through the following methods, method number 2 and 3 are essentially related with using the transaction value of identical or similar goods on the goods being imported, right? Under certain conditions. As well, if we go to the method number 4, this is the deductive value method, right? So which means that essentially the value to be taken for customs purposes will be based on the unit price that such good or identical or similar goods are sold at first commercial level in the country of importation. And then if we move on to the computed value method, right? So it's the method number 5. So this is also known as cost plus, and it essentially consists in building up the value based on manufacturing records, right? So it is merely composed by the cost of raw materials, several expenses, and the profit necessary to build up the price. Nonetheless, this method is not easy to use because it implies that the importer should have access to the manufacturer records, right? And finally, we have the fallback method, method number 6. That essentially means that the importer, if he or she was not able to allocate or determine the corresponding customs valuation method, it should go in a second round to the previous methods as well, but using a reasonable means and objective data, right? So which means that apply those methods with more flexibility. All right, so I will pass over to Yuli in order to have some interesting conclusions about the comparison between these two methods.
Thank you, Edson. So now that you've heard about the TP and the customs valuation methods, bringing the two together, you might think that, well, both talk about cost plus, both have something to do with resale. The important thing is to see that those two methods are actually completely independent of each other. And as Ramia mentioned, cost plus method is typically used in manufacturing production type of cases, whereas and it looks at the profitability of the entity from TP perspective, whereas computed method from customs valuation perspective will look at the specific transaction and will just look at what was the initial cost of the product and how much should be added to that price for bringing that product into the different market. Similar, the two resale methods should not be confused between each other, because one again looks at the price in the market and trying to define back the deductions to arrive to what the importation value should be. So that's on the customs side, and the resale price TP method actually looks at, we know the price in the market because that is a third-party transaction not influenced by intercompany relationship. So that price is known. Then if we derive what should be the profitability of the company of similar profile, then we know what should be the profit that that company should make. So if we summarize all of that on one page, you will see that actually all the three TP, customs, and VAT have a different look at different principles. And if we look at, for example, transfer pricing looks at holistically at the company's profitability mostly, and looks at everything on a financial year level. Whereas VAT and customs are much more transactional and go look at the pricing determined on particular transactional level. The time point of determination for different taxes will also differ, because again, for transfer pricing, we would look for the total financial year, whereas for customs and VAT, the tax point will depend on when the goods cross the border, or when particular shipment crossing the border, or for VAT, we would primarily look at the tax point when the invoice is being issued. So this is basically sort of the theoretical part that we wanted to share with you. We have a number of practical cases that we wanted to explain to you, with hopefully will make that theoretical part a bit more alive and give you the understanding of how things will actually work in practice. So with that, I'm passing over back to Ramya.
Thanks, Julie. So let's talk about some of the case studies at hand. The first one being trying to establish a management fee recharge going forward. Now, in this current example, we have a UAE headquartered group which provides management support services, say in the nature of internal audit, human capital, IT support services, admin support services, finance support, legal support, and all the other centralized support services to group entities. And this has been going on historically. So this UAE headquarters service, the UAE headquarters was for many, many years providing this support from the UAE, but was not recharging, let alone earning any markup on these services to group entities. So in the current example, we have this entity, which is, and let's take the example of, say, one group entity, which is based in the South, in Saudi. As I said, nothing was done before, but now with the implementation of corporate tax law and transfer pricing provision, the expectation is that the UAE headquarters should earn some return for the centralized support services, considering that if the services were actually provided to an independent entity, they would expect a return. So the UAE tax authorities may challenge the fact that nothing is being recovered from group entities, and all this cost is actually sitting within the UAE headquarters, thereby reducing the profit that is offered to tax. So the group is now in the process of establishing a TP policy. And one of the challenges, of course, is how to go about this extensive exercise of putting a policy in place. But the second challenge that they are going to have is the fact that the subsidiary entities, the group entities, would also, the authorities in those specific jurisdictions are also going to challenge the fact that historically there was no charge, and now suddenly UAE wants to, recharge these costs and a markup. The other challenge from a corporate tax standpoint would be the withholding taxes. Now, this was not really budgeted for by the group itself historically, but now going forward, there's an impact that this will have. So just from a CT and transfer pricing standpoint, there are many things that the group needs to consider while implementing this transfer pricing policy. But then it doesn't just stop there, right? You have other considerations, and more importantly, value-added tax related considerations, which Julie would now talk through so that the group should really holistically review the transfer pricing policy in view of other, tax aspects as well. Over to you.
Thank you, Ramya. So on the VAT, so obviously it is the HQ in UAE who needs to determine the VAT treatment of that management fee. But what we see very often happening in such an intercompany relationship is that the subsidiary will start challenging what those charges are, and they might start questioning the level of such fees, and therefore say, if you have incurred additional costs that you're wishing to recharge to me, we want to see the exact specification of what those additional costs are. So please include them or specifically on the invoice or in a separate specification. We want to know what we are paying for. We want to break it up in our cost structure so that we allocate the costs where they belong, whether it's HR, procurement, or something else. And then the question comes, what is it then for VAT purposes? Because if we just charge a management fee, a lump sum, then it will clearly have just one VAT treatment. If we start breaking up the costs in different elements, then do we need to then determine the VAT treatment on each individual sub recharge? So that's one challenge. Second is, as Ramya mentioned, in the past, such costs actually haven't been recharged. But if we're now from TP perspective saying, well, actually that support has always been provided, then from the UAE perspective, the authorities can say, well, if that service has always been there, should we not see it as a deemed supply? And in let's say, an international relationship, this might not necessarily directly be an issue, but definitely in a local to local situation, it may give rise to additional VAT cost that was not previously anticipated, because potentially the FTA might go back into historical 5 years and say that that deemed supply has been there. So that's kind of the little snapshot of the VAT consequences. Adson, is there anything to consider from customs point of view?
Thanks, Julie. Well, typically management fees only have a customs implication if they are related with tangible goods being imported. So in our experience, that is not common, right? And in this case, for the specific example, if the importer, well, the company is receiving the management fees in KSA, so eventually, if it is related with tangible goods, the importer there will have the customs implication on the headquarters in the UAE. Now, let's discuss another interesting case on royalties. So over to you, Ramya.
Thanks, Edson. So royalties, I think earlier in the presentation, Edson mentioned that some of the adjustments that need to be made from a customs standpoint relate to royalties. So what does it mean from a transfer pricing standpoint? So in this illustration, we have the headquartered based out of USA, and this entity has granted exclusive rights to sell their products in the UAE to XYZ LLC, which is based in the UAE. Now, the headquarters charges XYZ LLC a royalty fee of 1% on total revenue based on the transfer pricing analysis conducted by them. From a transfer pricing standpoint, the purchase transaction and the royalty transaction can be treated as two separate transactions, or the value of the purchase itself can incorporate the royalty element. So it is a case on a case-to-case basis, and the taxpayer really needs to evaluate what works best for them. But this may have a consequential impact from a customs standpoint, which Edson will now talk you through.
Thanks, Ramya. Well, from a customs perspective, as I mentioned, royalties are quite relevant, okay? And for the specific example, I would say that in order to determine whether the royalties should be added to the transaction value, that is, in the end, the customs value, there are three main conditions that should be analyzed. The first one is that the royalty should be related with the goods being imported. That is the first one. The second one is that the buyer must pay that royalty to the seller as a condition of sale. That is quite important condition as well, condition of sale. And then to the extent that such royalties are not included already in the price, okay? So essentially here, we have seen that many customs authorities across the globe has taken an stringent approach in relation to royalties, and they are asking to add those regardless their nature. So here, essentially, what we recommend is before deciding to add a royalty as part of the customs value, it should be analyzed whether those conditions are met. Otherwise, there are enough good elements to challenge that position eventually. So that analysis should be made based on contract and agreements related with the royalty, record keeping, and some other kind of documentary evidence. So let's move on then to what are the VAT implications here?
Well, as VAT typically follows customs for the determination of the import value, in this case, it becomes very relevant whether that royalty will or not influence will be seen as an addition to the customs value. And basically, normally, any service that you receive from an overseas entity would lead to reverse charge reporting on its own. But at the same time, if that same royalty has been added to the customs value of the goods that are being imported, then you would already pay import VAT on the customs value, including that royalty. So in this case, you might end up paying VAT twice if you're not really looking at the combination of customs treatment and VAT treatment. So in this case, will be very important to understand, has the royalty already been included or not? And that will drive how you report it for VAT. So I think that's also a little bit the difference between management fees and royalties, the two cases that we've explained to you, where management fees typically are unlikely to lead to any customs consequences and are fairly simple in terms of treatment from VAT perspective. Royalties, as such, are always a trigger to look further from a customs perspective and therefore create more complexity. So now over to the third case is, I think, the most challenging one is the year-end TP adjustments.
Thanks, Julie. Rightly so, transfer pricing adjustments are a hot topic. And the corporate tax law actually provides taxpayers opportunities to make a transfer pricing adjustment. This could be either at the end of financial year, at the time of filing a corporate tax return, or after a potential scrutiny, and the FTA may adjust the transfer pricing policy and the transfer price itself. In this particular case, we have examined a case where we have a routine distributor. And as a routine distributor, the distributor is required to actually maintain an arm's length return aligned with its functional profile. Now, based on the operations of this, which was carried out by the distributor, they were not sufficiently maintaining this return in the UAE. And as a result, the distributor now receives a true-up adjustment from the principal or related party as a year-end subvention to meet the arm's length return as per the company's functional profile and the transfer pricing policy. Now, from a transfer pricing standpoint, the books are now adjusted and are truly reflective of the price or the return that the distributor must earn. But then there would be certain challenges and certain implications from a customs and value-added tax standpoint. So over to Edson, who will now take you through what it means from a customs perspective.
Thanks, Ramya. Well, from a customs perspective, TP adjustments and their implication in customs valuation is actually a key topic, or hot topic, if I may say, in different international organizations, right? Such as the WCO, WTO, OECD, the World Bank, and actually the International Chamber of Commerce, as well as some other tax authorities across the globe. So I would say that possibly in other countries, this topic has been even matter of several disputes in terms of how to affect, or if the transfer pricing adjustment should be affect the customs valuations, such as the well-known Hamamatsu case in Germany, and also, for example, tax authority in the UK, HMRC, are actually possibly questioning whether the margin-based TP methods can be used when the importer uses the transaction value. All right, so here, just having been decided that the transfer pricing adjustment will affect the COGS, the value of the goods, there are several elements to take into consideration. First of all, the importer should try to identify which products will be affected, and if possible, which invoices presented at customs and prices should be amended. So that is not an easy task. There should be an exhaustive reconciliation process in order to determine so. And also, once we have determined the amount of the products affected and invoices, we should analyze whether the TP adjustment is upwards or downwards, right? So upwards, which means increasing the value of the goods, or downwards, decreasing the value of the goods, okay? So in any case, there is also some aspects that should be analyzed, for example, for the customs duty liability, right? So if we have an upward TP adjustment that will increase the value of imported goods, obviously we should analyze whether the goods are subject to actually a customs duty rate different than zero, right? If it is 0%, obviously there is no implication, but there are several aspects to consider there, and the recalculation of customs duty may be necessary, as well as the customs evidence and documentary evidence to support that TP adjustment. So just to give you an overall approach in terms of key aspects on retrospective adjustments and prospective adjustments. So I would say that for retrospective adjustments, as I mentioned, it is quite important to analyze the customs duty liability, but most importantly, which possible simplification measures are available, right? So for that purposes, it may be recommended to approach the customs authority once the importer has a case, and a strong case to justify the TP adjustment, in order to see what is the best way forward to comply with this eventual payment of customs duties. For example, the International Chamber of Commerce has issued some interesting proposals to the different customs authorities, prompting them kind of, for example, allow the importers, instead of amending the whole bunch of customs declarations, just to present one tax return and affecting the different customs declarations in one single tax return, let's say, right? Among others, that it is important to take into consideration. So from a UAE perspective, it will be interesting, possibly questioning if the self-audit finding service recently launched, for example, by Dubai Customs, will be suitable for these purposes, all right? And now, in relation to prospective adjustments, either downwards or upwards, it is important to have consistency on them. The importer should have a good analysis in terms of past, present, and future imports in order to avoid or have significant changes in the values, right? That may kind of trigger more scrutiny from the customs authority, and eventually that it may trigger a customs audit as well. All right. So now Julie will talk us through the VAT implications.
Sure. Thanks, Edson. So on VAT, we basically need to determine is this transfer pricing adjustment relevant for the cost of goods sold, or if it's not, in the VAT, we have a concept, if something is not a good, then it's a service. So the relationship between the transfer pricing adjustment and the goods previously imported or acquired by the entity, this is what will drive the VAT treatment. And if we conclude that there is a relationship between that transfer pricing adjustment and the price of the goods, then we basically need to see how do we practically process that. Because if you look at the credit note requirements in the UAE, you actually need to refer in your credit note to the original invoices. And if you're making a transfer pricing adjustment for a whole year worth of supplies, then obviously brings a practical challenge of how do you link it. So from that perspective, actually it's relevant to see how can you limit the transfer pricing adjustments, and how can you monitor your transfer pricing during the year and adjust the price, the intercompany price as you go, so that potentially if you do need to make a transfer pricing adjustment, you don't need to refer back to all the 12 months before, but it essentially only refers to the last 2 months of your financial year, hence making it easier to connect the original sale and the transfer pricing adjustment. So another important point to consider from VAT perspective is there an underlying reason why that transfer pricing adjustment being done? For example, if the entity, if the subsidiary has not reached the desired level of profit because of a special circumstance. Let's say they're one of the major customers went bankrupt and therefore they didn't get paid, loss of revenue, or any other these kind of extreme circumstances, and they're being compensated for that loss by the head office. So will that then be considered as a real service being received, or is it actually a compensation type of payment, which potentially then might be considered as outside of scope of VAT? So again, just coming back to the point that because of the way transfer pricing adjustment look at the whole year and look much broader at the profitability of the entity, and VAT is trying to bring it down to the transactional level, it makes it difficult to work with it, bring the two concepts together and make it an easy fix. So you always need to see how to make sure that both work together well, and how do you then report it in your VAT returns? Where do you report it? Do you need to do a voluntary disclosure? Do you need to process credit notes and things like that? So I think that's on this particular case, and this is pretty much what we wanted to discuss with you today. So over to Keith for the closing statement.
Yeah, thanks, guys. I just appreciate the time, so we'll try and wrap up here pretty quickly. Just a few key takeaways. Obviously, a lot to digest in there. I think hopefully you get a flavor of the fact that there is a lot of crossover between these areas, and we need to be very, very cognizant of both the transfer pricing policies, customs and VAT. All of them interact closely with each other. We've never had this really before, so it's important that we start to look at it now. So just a couple on the TP side of things. I think it's important that you obviously have strong intercompany policies. I also believe that we need to make sure that you have your various teams and networks interacting with each other. As I said at the start, between logistics, finance, tax function, all need to be on the same page. Wherever possible, we should leverage technology, and that's really around storing of data, transfer of data, et cetera, et cetera. And as I mentioned, it is important that we look at these things holistically. TP, customs, VAT do work together, and they're not independent of each other per se. What we will start to see a lot more of is the customs authorities will take an interest in what's happening in the transfer pricing space. And obviously the Federal Tax Authority will also take an interest, which then the next thing they're going to do is have a look at what are you reporting in your import declarations and what are you reporting in your VAT returns. So any adjustments, as the guys have mentioned, that Julie has talked about, that Edson has talked about, be very, very cognizant as to how they flow through either into your import declarations or into your VAT returns. Wherever you have adjustments, or you're going to make big changes in your transfer pricing policy, give consideration to the impact on the other two and engage with the authorities wherever possible to see that they are all on the same page. And if you need documentary support from the Customs Authority or the Tax Authority, that you have it, so there's no nasty surprises if there are audits down the track. I think, as Julie finally probably mentioned on the VAT side, try and, wherever possible, minimize the adjustments or make them real time, because it can be difficult to work backwards through that and credit note, and you don't want to miss tax points from a VAT perspective. So it's just a couple of key takeaways, but very important that we look at these things holistically. So that's it from our side. There's just a couple of questions that came through both before and after. We'll quickly wrap questions up because that's all we've got time for, which I think touches on a lot of what we've done already. So the first question we have, which we're going to look at, is how the TP adjustments impact VAT on goods imported to or sold into or exported from a designated zone. So designated zones are always a topical matter. Julie, would you be able to pick up on that? Just keep it very brief given the time we have.
Sure. Well, hopefully, when you're bringing the goods into the free zone, you're using customs customs suspension regime. And if you do, then that would mean that no VAT will become due. And therefore, even if any adjustment need to take place, you're basically, you don't need to consider VAT as such, unless these goods eventually will make their way through to mainland, but that's already the next step in the transaction.
Okay, that's very clear. And we'll just wrap up with one more question, probably more on the customs side. So, Edson, maybe you'll take this one. You know, what are we going to do? We're going to declare year-end adjustments, transfer pricing adjustments to the Customs Authority. So, for example, in the event that the local distributor works on LRD basis with a guaranteed net profit and gets an additional invoice at the end of the year, doesn't have to declare it to the customs as an increase in its initial transfer TPs. You know, if you can very quickly give us an answer to that, that would be great, and then we'll wrap up.
Yeah, thanks, Keith. Good question. Yeah, well, actually, it is necessary to analyze, let's say, where it's coming from this TP adjustment in order to identify the product being affected, the invoices being affected, the amount, and eventually the customs declarations that potentially can be subject to amendment. And secondly, obviously, approaching proactively to the customs authority will be a best practice in order first explain them the business reason of that TP adjustment, and secondly, well, in that line, which simplification measures are available in order to facilitate the payment eventually for that difference of customs duties.
Thank you, Edson. That's very, very helpful. Thank you, everybody, for joining us this morning for this webinar. We're a little bit over time. You should have most of our contact details. For any other questions or queries that you have, please send them in. Please complete the feedback. It's very, very helpful to us. We look forward to helping you and support you navigate customs, TP, and VAT in the future, as well as other taxes. Have a great day. Thank you.